session. To be hosting this webinar with our partner Making Finance Work for Africa. In today's we will look at interest rates on housing in Africa by looking at the determinants of high interest rates and then looking at measures that will be taken to reduce the interest rate cost of housing across the continent. We have with us today Dr. Michael Fuchs, who has recently authored for the Center for Affordable Housing Finance in Africa, the paper lowering the high interest rate cost of housing finance in Africa, which he will present us today. He's currently working as a consultant largely to the World Bank and other donors on financial sector development in Africa and East Africa. Until June 2013, he was a sector manager in the finance and private sector department of the World Bank Africa. Since 2002, Michael has worked extensively on financial sector development in Africa, leading countries and a group of countries in the East African community, as we see reform and technical assistance operation, including in Kenya and Nigeria. Prior to the Danish Central Bank and the Danish Ministry of Finance, he holds a PhD in Copenhagen and a bachelor degree from the University of York. We are pleased to have as a discussant Mr. Mfundo Mabaso, Managing Business Development at First National Bank International in South Africa. He will with us his experience in working in countries with high interest rate environment. Into the main subject for today's discussion, I just want to mention a few housekeeping items. Today's webinar is scheduled to last 1 hour. To ensure the quality of experience, all participants will be muted. But during this Michael's presentation, you can still submit via the chat or the Q&A box your questions, and Michael will then answer them after his presentation. So at the end of the presentation, don't forget to fill out the survey that will appear automatically. I will now have a brief overview of CAF's strategic partnership with Making Finance Work for Africa to Michael's presentation. Center for Affordable Housing Finance in Africa has, with Making Finance Work for Africa, shared interest in deepening the understanding of the housing finance market in Africa. Our objective is to innovation in housing development and finance, and to support housing finance market activities such as working group, case study and knowledge brief, and webinars such as this one. I want to now turn to Michael Fuchs, and we look to hear from you, Michael. Up to you.
I seem not to be able to share my screen. Thank you. See the slide. I'm about this. You can all see the slide now. I'm going to talk about this very comprehensive topic, very large, broad topic, and try to divide it up into 4 different perspectives, if you like. I'm going to address each of these perspectives from the perspective what's the issue we're actually trying to address, and then I'm going to talk about some of the remedies that could be applied to each of them. At the determinants of high interest rates from the perspective of high policy interest rates. Another coming up is high credit risk premiums, high maturity premiums, and limited use of collateral. The 4 categories of issues that I'm going to be addressing within this short presentation today. We go directly into it. The first issue, certainly pervasive in Africa, are high policy interest rates. They reflect very shallow financial markets, difficulties in managing liquidity and in the financial system, even at the very short end, and as a consequence also risk-free government borrow rates, i.e. the rates which are set by the government have a tendency, because the markets are rather shallow, to be volatile. part of for this, or the main reason for this, is that governments have very high borrowing requirements, and you refer to this as fiscal dominance. Over-reliance on one or core commodity is one source of that. One commodity prices fell in recent years. When commodity prices fell, fiscal revenues fell, and governments had to borrow more in local markets. Even those countries, though, which didn't suffer from commodity price changes, the reliance on borrowing has still been prevalent in Africa. For example, countries like Kenya, which had a large infrastructure and other investment. So one of the issues here is how can the government actually how can a government be a lesser player in the local markets and therefore contribute to greater stability, placing greater reliance on private sector funding. As a result of this, or a symptom of this, you also see that markets are not contributing much in the way of the banking system doesn't contribute much in the way of credit private sector, and this is more prevalent in some countries than in others. But the general gist of this is that countries are not the banking system, the financial systems are shallow, and that's part of the result of this high investment in government securities, which relate to the fiscal dominance issue. This channel for second determinant of high interest rates are then high credit risk premiums. The financial systems are quite small, and they're unable to benefit from economies of scale because of their size. As context, they're very high overhead costs, high operational costs, and this is best illustrated for you here. You see a decomposition of interest rate spreads across a number of countries in Africa, and you see the largest components of spreads in the financial system are overhead costs and profits to some extent. So these systems are not very competitive, or they're very costly. They're unable to contain their costs because they require very specialized manpower, and the competition in that market is weak. You have in many systems the dominance of large banks, and as the government is borrowing a lot, it's far too easy to invest in government securities, and thereby the actual business to innovate, to invest in looking into things like whether should they banks lend more to the private sector, in particular in this case to housing. That is reduced due to this rather competitive system. I see this here in the high interest rate spreads that exist in Africa when you compare them to others, in the OECD, for example, getting higher cost base for the financial system, and thereby this is passed on in the form of cost to borrowing from a bank, including those who might want a mortgage. I just wanted to emphasize before I go to the third that the cost of spreads is particularly high for mortgage loans also because the mortgage market, the cost of equity is very high. That's to say, the risk weighting applied to mortgage loans is higher than it needs to be, really. And that reflects the lack of ability to recognize the value of collateral in that lending. Risk is considered high because of weak efficient systems and weak enforcement environment, and said operational costs are high also for mortgage business, and lending costs are high in the sense that banks don't have long-term funding, so they're limited in the amount of maturity transformation they will undertake. Balance sheets. Back to that issue. The third channel I'm looking at is impacting high interest rates, the high maturity premiums. mismatch between long-term borrowing needs and the available short-term funds. Domestic markets are liquid, and it's difficult to get hold of longer-term funding. The government bond market doesn't really provide a good benchmark on which borrowing in the private sector can take place. It's not that deep, and said even on the short end, it's pretty stable. And investors aren't really engaged in the mortgage market. The one take here is that the high maturity premiums are important, but on the other hand, one must be careful before saying that the interest paid on mortgages is determined by their maturity. So it's important that some maturity is provided to mortgage borrowers, because it's not the absolute level of interest rates which is actually so important for the cost of mortgages. If you look at it more carefully, it's actually the maturity of the borrowing. So it's making available funds with sufficient maturity that determines the actual cost to the borrower on a monthly basis. I'll choose shortly. The final I want to talk about then is the limited use of collateral, and this is kind of fundamental, I think, the cost of housing finance. The operating environments are very difficult for most lenders, and they vary even across regions within a country. The time cost it takes to register collateral or value of or a property, and then to the conveyance of the title in that property are really very detrimental to the ability to use housing as collateral. And then when it comes to enforcing, when there's a default or there's need to take recourse, realizing collateral value, borrower defaults, it takes time and is costly. So there's lack of familiarity, and the markets are rather untested in the resale of collateral. It's kind of fundamental to the whole of the mortgage market, and it doesn't work very well in most countries in Africa. So I will now talk about some of the things that could be done to address some of the topics I just mentioned very, very briefly here. A first one obviously would be to strengthen macroeconomic management and reduce government borrowing. A very tall order. It lies rather far away from the agenda of reducing interest rate costs in housing, but it's very important that as a broader background for that. I mentioned already that the domestic debt markets don't work very well, and there are ways of improving the function of domestic debt markets and increasing the availability of benchmark issues, for example, in the debt markets could help, and does help normally to deepen those markets. This is not something that happens overnight. It takes time. The important thing, I think, actually is the one about reducing government borrowing, and therefore governments have tried to borrow abroad, and using that going on in recent years quite a lot. Euro market borrowing has increased quite a bit again, but this in the term may look like one way of avoiding the crowding out issue. In the longer term, it's likely to come back and haunt the government, because once it's borrowed abroad, it has to bear foreign exchange risk on that borrowing, so you have to borrow more later. The short-term fix, it has been tried in recent years, and so successfully. There have been a number of countries which have said that the borrowing costs and the spreads I just showed you are just too high, and we need to intervene in that and do something about it. So Kenya and Zambia are countries where interest rate caps have been imposed. I think common to Zambia and Kenya was a sharp drop in the growth of credit to the private sector, so it didn't actually have the desired impact on making borrowers better access to bank credit. The opposite happened. Banks found other ways of either restricting the borrowing the lending they were doing, or imposing fees which they did to a large extent on borrowers in Zambia, where they have discontinued caps, and the discussion is very much ongoing in Kenya. And now they have reducing the high policy interest rates has been through subsidies that have been really very difficult to administer on a select basis. There could be a case for subsidies, but they have to be very smart subsidies. And they probably to address, they need to be designed so they address the first years of a borrower, the borrower for a mortgage, for example, when the cost is high. And if it's in terms of nominal terms, where the burden on the borrower will be greatest, and being cases where this has been done. I think African countries, the problem with this is that once you institute subsidies, borrowing, they don't really need to repay on their loans because someone else is paying for them, and the party can bear that burden better than they can. So there's a moral hazard question here, really. The second of the areas I spoke about before, about credit risk premiums, or that the very high spreads in the banking system. There are ways of reducing those spreads, and they perhaps lie an extension of what would be regarded as mortgage finance. But they are one of the big problems in the Africa context is the lack of competition there is in the banking system, and this does go back to the regulators as much as to the banks. I think the regulators bear a good deal of responsibility for this because there's been very little funding of banks once they meet issues in their loan portfolios, rather than attitude of the regulator in many countries has been that of forbearance and allow this to carry on because they don't really want to create a politically or embarrassing circumstance for themselves to be done there. Another area where there's much more could be done is on sharing credit information. This is which by you get to the borrower or the knowledge of the individuals who actually live up to their commitments to financial institutions become more shared among them. And of course, there's much better credit management. There are efforts in most countries to try and do something about this. They are, I think, in a kind of evolving state and not developed yet in most countries in Africa. For instance, insurance is one way of strengthening competition by providing a more level playing field between large banks and small banks, because small banks generally don't have the trust of small depositors because they're small and they're not known. The danger, of course, is that once you establish a deposit scheme, you may also establish some of that moralism may again come into the financial system because the banks benefit from something they don't really feel responsible for, and they feel that the large banks bear the burden of the deposit insurance coverage, and therefore they don't really necessarily benefit the system. So it has to be made. It has only undertaken where the issues related to before about supervision of banks are addressed at the same time. The third was lowering premiums. This is important in making longer-term funding available to the banks. An area where this has happened and is happening in many countries in Africa, and I'll slightly diverge here, is in the use of mortgage facilities. This started in Egypt and undertaken in Tanzania, West Africa, Nigeria. So this is actually something which is happening. The liquidity facilities are a kind of centralized bond issue, which banks can access to offload the maturity risk they have in their mortgage lending. So as long as what the banks do is to provide the mortgages as collateral on a recourse basis. If there is a defaulting borrower among the mortgage borrower, banks have to replace that mortgage with a performing mortgage. The disadvantage in this is that we're still impacted. The cost of borrowing for the mortgagee is still affected by the spread that the bank is on, and as I said, the spreads are very high in the system. What it does do here is, and this is the important part of it, it allows the borrower to take a mortgage of a maturity equivalent to, of a much longer maturity than would otherwise be available to the borrower. And as the main relief provided by financing at all of a mortgage is closely related to the maturity of the mortgage, is really very important relief to borrowers, mortgage borrowers. This instrument, which has started to work in certain countries in Africa, I think there's a lot more process here for making housing finance more affordable, and this is probably something we should be seeing more of, I hope, in the near future. There are other ways of reducing the maturity premiums, but they are way more sophisticated, and one of those is to use covered bonds. The covered bond market is more efficient, more effective. It reduces those spreads I spoke about, but it depends on a much more well-developed institutional environment, because it's not you don't replace mortgages one with another. So as you do with a liquidity facility, but you have to actually have to make this more efficient. You have to have a very good recourse system as the a defaulting mortgagee is concerned. There has to be a very effective way of dealing with risk in the system, i.e. of closing on a mortgage and actually repossessing property, which doesn't really exist in countries in Africa yet. Then, of course, back again to the long-term funding issue. What is the benchmark for that funding, which liquidity facility, for example, could undertake? And again, we come back to the issue of establishing a yield curve for government risk as being a basis for whatever long-term funding can be established. Then an issue which is prevalent or could have an important impact on lowering maturity premiums is the size of pension fund asset investment. And this is from Latin America, you see, but the general gist of the story here is that the more the pension funds have invested, the lower the mortgage interest rate has become. Of course, making institutional demand available is important if there are to be used, for example, as I was saying, by a mortgage facility. Who's going to buy these? And if that market is going to be run efficient, then the more of having more institutional investors will be important. The fourth set of recommendations refers to leveraging utilization of collateral value. These are things which I have touched upon before, but are really fundamental here. So, the strengthening property collateral registration and for closed mechanisms and credit information sharing, which I had before in the slide before. Very significant impact on the whole mortgage market, but they're not things that are going to happen quickly. And then a way of perhaps leveraging collateral value better is, instead of insisting that you the malfunction of the property relation system, in doing industry handing over the value of the property and lend against a property, the lender could provide installment credits to those who occupy that property. It's rather like a leasing arrangement. It has been tried, and the disadvantage has been that those leasing the property don't regard it as their own. It isn't until the lease is complete, so to speak, until the installments are all paid. And that gives rise to less, they don't therefore look after the properties quite as well, and has given rise to issues relating to the maintenance of property. Credit guarantees might also be something worth considering. They are there are partial credit guarantees in some countries in Africa which work very well. They haven't been that prevalent in the mortgage space, but there are SME finance. They've been used quite a lot. The bank thereby reduces its exposure. The guarantee takes perhaps 50% of the bank's exposure, and the bank therefore doesn't take as much risk, and therefore it should increase the scope for lending. These partial credit guarantees are quite complicated, and much depends on how they're actually designed as to whether banks find them attractive. It always such, I think, that banks are not familiar with them. So much technical assistance also has to be given to banks to understand how this instrument works. But that is certainly one way of increasing perhaps appetite for this market, while the institutional reforms mentioned under A here take place. Another avenue to increasing mortgage funding has been through in savings. So a certain portion of the pension savings that individuals have could be used on providing them with a home, so they can borrow against their pension savings to be able to fund their home. This has been in South Africa quite a bit, I think, and it's something that perhaps could be pursued elsewhere. As it says here, one of the issues here may be again to repossess homes when there is a problem on paying on the mortgage, and the kind of exposure that the pension funds and the trustees of a pension fund may not welcome very much is to having recourse to an asset such as a house, which is not kind of the way they'd want to see their investment what they would want to see in their investment portfolios. In fact, many pension funds have had difficulties, whether in real estate, usually commercial real estate, in their risk in this space before, or it's well known in some African countries. So this is not a free lunch, but it's certainly something one could try. And there are a number of other ways of assessing affordability. One is adjustable interest rates, which I'll come back to, but I think adjustable interest rates are okay. They introduce a new kind of liquidity risk, of course, for the borrower. So they transfer uncertainty to the borrower, and the mortgage borrower may not be made aware of what kind of risk they're taking. So this is a discussion I think in most cases mortgage borrowers like to know that what they're going to be paying month by month, rather than being exposed to that kind of risk. More to the point, has been borrowing foreign currency, and that has been tried. And there are institutions in Africa who do intermediate foreign currency related mortgage loans, in Ghana, for example. And the difficulty there is knowing exactly what's going to happen to the foreign exchange rate, of course. And the Ghanaian arrangement is very much functioning so that it only provides that kind of exposure to those who manage their foreign exchange risk. So it's those with foreign exchange earnings. And so it's rather a limited market, but it's something which is working quite well, I think. Index-linked borrowing has also been tried in Ghana, for example, but it's also been broadly. And I think the problem there, the problem with index-linked borrowing is index and how to define the index. In stable inflation times, countries with relatively stable inflation experience as well worked okay. But in periods where the inflation is higher and the inflation index for exposure to the mortgage is not quite the same as the broader inflation society. The inflation CPI, for example, is not matched by what wage inflation is in the country, you get problems with if the cost of the mortgage was linked to the consumer price index, the cost of the cost can increase quite sizably if the wage inflation is not the same as with the consumer price index. So you get inconsistencies in the data in the indices which are being used to track cost, and that obviously in high inflation experiences leads to stress, and actually it's being quite troublesome. This doesn't seem to work so easily in countries like the ones we're talking about here. So just to conclude on this, I think that mortgage is very important and to the affordability of mortgage finance. And I think one of the things is to keep it relatively simple. And I'm referring, for example, to experiences with adjustable interest rate mortgages and index-linked mortgages, because I think they're not easy for handle. And there's evidence this is not just an African problem. Fixed mortgages do provide that comfort. Then there's a known repayment burden, really falling repayment in real terms. It's likely to happen. So going back again to the idea of subsidy, if at any stage you have using fixed rate mortgage, it should be targeted at the first year of the mortgage and not targeted for the whole of the mortgage. I think the other thing I'd like to say, and there's been a lot of discussion in many African countries on borrowers not being able to pay more than single-digit interest, for example. That discussion is, I think, the data suggests that discussion is actually off track. What really means a lot for borrowers is what maturity of the mortgage is, because the time periods, the longer the time for the mortgage, the length of the mortgage determines the cash flow for the borrower. And we really need to try and find extended terms for borrowers, and then find that the actual cost of the mortgage is manageable. It's not the level of the interest rate that matters so much. Finally, of course, there raises a lot of questions about how you educate, whether they're well informed about what they are actually engaging in, and the consumer protection aspect certainly needs to be more well developed than it is in most countries in Africa. And there's a huge educational and technical assistance type of effort to be done in supporting the market and in making sure that those who receive mortgages receive affordable mortgages. Thank you very much.
Very much, Michael, for this presentation. We now move to the discussion part of this webinar. Moving on to you. Can you talk a little bit about FNB experience working on countries in Africa with high interest rates and how it is your capacity to grow your mortgage portfolio? I don't know if you can hear me and if you are connected. Can you mute yourself? Meantime, what we do, Michael, is that we can start. We received several questions from the participants. I will go through them and leave you the mic. From CRS, asking about the absence of immediate incentive for banks in terms of collecting data, but because the role of dependent on bank participation, busy growing their businesses, and so data of priority. So what else could be done to address this in absence of immediate incentives? We also heard from Mohamed Gay. Is asking, do you think that rental housing could enjoy lower credit risk premium and rate? There is no foreclose, but just need to replace the tenant and costly foreclosure process. So a question about the opportunity of rental housing to lower credit risk. We question from Pamela Lamoro, asking what role, if any, does the provision of some sort of mortgage insurance guarantee program in the country play in supporting more affordable housing finance?
So I hear that.
Last question from Pamela Lamoro is about the role, if any, does the provision of some sort of mortgage program in the country could play in supporting more affordable housing finance? Just we start with these first three questions, and then perhaps go back to Fundo and take some more questions.
Yeah, I'm not sure quite what the first the first question was referring to. Is it clear to you, Olivier?
Yeah, go back to the question. Yeah, role of information, right? And Kesia was asking what can do to address can be done to address
That
data collection.
Very fast evolving, very fast changing space in the financial sector, because with the arrival of kind of data type efforts, which relate, of course, mostly today to mobile financial services rather than the ones we're talking about here, the scope for seeing these kind of markets is changing very rapidly. So there was in which you can manage the credit risk now much more on basis of what kind of much more detailed and information based than you have had up at your fingertips up to now. I have seen this actually apply to these markets, but I guess another issue here is whether some of this can become public good rather than just a private good. That's the issue here. That's why credit information sharing has been quite difficult, because it assumes the market participants understand that by sharing information that they will gain as a collective. They each gain, think they may not each gain individually. And I think the main hurdle to be crossed, even when you're talking about the big data revolution we're seeing in these years. There seems to be the market for rental in Africa seems very weak indeed, at least in the formal market space. There may be a kind of informal rental going on quite a bit, but it's a market which obviously would benefit a lot from further development. A lot of background noise just now, so yeah, okay. And of course, it would be easier to shift tenants out than it is to foreclose. Well, I'm not so sure it's so much easier to shift tenants out than to foreclose on a mortgage, but that's I guess that's a practical issue one has to resolve. But I guess there are issues here as to the legal and framework for the rental market in many countries is not that strong, and therefore it may not be so easy as the question was implying. I think there's much more scope for doing more in the way of guarantees, mortgage guarantees, as I think I was saying in the presentation as well. I think there's not been tried that much, and there is scope for thinking about how to introduce a guarantee mechanism. In fact, is a way of replacing collateral, because the guarantees, in fact, that should be seen as collateral for a bank loan. Again, it's a short-term way of dealing with a problem, and until that becomes more really available as a security for a mortgage. Talking about mortgages, I guess we really need to focus on how best take that the house, the value of the house, the collateral, because this is such good, it's just, for a bank, it's the best kind of collateral they can imagine if it was working fully. So while I think the guarantee is a good idea, still the real problem is to address the registration conveyance. foreclosed there are on rate, which is a fundamental issue in mortgage finance.
Oh, very much. I think Mfundo is back online. So, Mfundo, if you want to comment a bit, and then we'll take more questions after your intervention. Thank you.
Cindy, can you hear clearly?
We can hear you very well.
Okay, good. Yeah, no, I think having listened to some of the president, some of the issues that were raised from a banking point of view, and particularly F&B having played in the rest of Africa and particularly in South Africa, I definitely relate and to a few. So I was really excited when you started talking about mortgage guarantees. So it worked extremely well for us when we were playing in the lower end of the market to try and make mortgages more affordable. It afforded us the opportunity to actually extend credit to the full value of the required amount, so at 100% of the loan to value, as well as although couldn't extend fixed interest rate over a period of time, we could at least offer the fixed interest rate over a 5-year period, which gave the customers in the lower end of the market more comfort and a security around knowing how much they were going to be expected to pay for that period of time at least. So amongst the things that we've also found, I beg your pardon, let me just go back to mortgage guarantees. So we then took that model, which worked very well in South Africa, and wanted to apply it in the rest of the countries that we play in. So specifically, we've rolled it out in Tanzania as well as Zambia, which we have found has actually given us a little bit more leeway as well. In terms of the long-term funding, affordable funding, that has been one of the issues that we have found ourselves in as well as a bank, particularly in Zambia, when liquidity issues from a broad scale that she was facing liquidity issues. We found that we needed to find a lot more institutions that were willing to advance long-term facilities to us so that we could on-lend those to our clients. So with some DFIs, and we've been approaching a couple of pension funds as well. So I think predominantly the content of your presentation I could really resonate with, and we've been grappling with the same kind of issues from a practical point of view on how do we actually take the issues that we're facing and actually, make them workable so that we can extend it at a more affordable rate to our customers. So I think it was really, really beneficial. There are a couple of things that I'm going to come back into detail just to find out what are your suggestions about. But yeah, all in all, really beneficial presentation.
Thank you, Fundo. Very useful. I'm going to read them to you and to get your comments. So we received a question, Megan Sager, who was asking what contributed to the success of Africa's mortgage program. And we received another question from Kesia Rust. Mortgage design, what is the impact of creating demand from now for houses below $1,000 and go as low as $7,000? Would such a mortgage design or some over others?
Yes, I can answer. Yeah, I'm fine. Home loans, I believe is the success of this company is the one I mentioned before, because that home loans is largely doing lending in foreign currency and able to bring interest rates down. Those borrowers who have incomes or other assets which are denominated in those currencies. So it's a special niche of the market it's serving rather than the broad market. And I think that yes, it's functioning well, it's well managed, and it's a success. But its scope is to be limited by the client base which has such assets. And I'm afraid I'm more it has a limited applicability than I would like to see, and certainly you couldn't, for example, do that for the kind of micro borrowers the second question was addressing, because they wouldn't be able to cope with the risk associated with foreign currency borrowing. Foreign currency borrowing was such that the kind of experience is very in the European context is quite clear, where borrowers borrowed for mortgage borrowed in countries like Hungary and Poland decided before the financial crisis they would borrow in Swiss francs because it was going to be cheaper for them, and in these cases there's been very heavy lessons has been learned by those borrowers and by that process. So we'll have very careful. The micro mortgages perhaps relate back to the question which was asked before about how we can improve data, because if data must be an important part of that. So information sharing about those borrowers who might be taking micro loans would make it much easier for micro mortgage markets to expand more rapidly. Again, it's very dependent on the credit risk that those micro institutions are taking, and we're able to manage that risk. I guess in a sense that goes back to a question as to whether there's any common bond among the borrowers for micro mortgages, and that wasn't the nature of the question. Was not part of the question here, but it would that reduce the credit risk if there was some felt responsibility among the borrowers for repaying the mortgage. That again would substitute for some of the missing knowledge about exactly what kind of risk is being taken by the lender. Same would apply to other mortgages about the security of that lending, security for that lending, and whether you can actually foreclose on micro loans of that kind or not.
Okay, thank you very much, Michael. It's very clear. I think we have some questions. I invite the participant to send us now to Q&A. I received an additional question from Len Ayman. There is information where it's provided a gateway asset towards more. Answer that, Michael, please.
What is housing finance?
I think she means the incremental, in terms of incremental construction of houses. So housing project to fund incremental housing building.
Mortgage finance in Africa was incremental finance, if that's what it meant by that question. Yes, that is the usual way that when you have access to a mortgage, you fund the building of your house, so to speak, as time goes on. The advantage of that is that you can take many small increments, and if you're building the house at the same time, the actual cost of funding you'll find much smaller than if you take a larger loan for a long period. Maybe that's self-evident, but that reduces the cost of the mortgage in that sense. But it means that you're kind of in a situation where you're living in half a house, and you suddenly, when it comes to an apartment building, you can't build half an apartment. So it limits the scope very much of what kind of you can afford. It's not the ideal way of going about solving the problem, I think.
Thank you. We have another question from Steve Timpona asking if do you view well-developed housing cooperative in Africa that can bring larger pools of pre-qualified middle-class applicants to the mortgage market as a more affordable investment in the sector?
I get that. Sorry, you have to repeat that.
Do you view well-developed housing cooperatives in Africa that can bring large pools of pre-class applicants to the mortgage market as a more viable avenue for attracting affordable investment in the sector? So the role of housing cooperatives and SACCOs. Yes.
Yeah. Again, this is going back to the question, the issue that was raised before. I think if the fact that it's a cooperative means that the members of the cooperative know each other well and feel a common bond for what they are for what risk they're taking in funding housing for the members, and they can contain the risk in that way, so that they know that those members won't run from their obligation, as would any not unknown third-party private person. That actually can reduce the cost because you're actually addressing the credit risk premium, which I spoke about. You're trying to reduce that premium because you're actually lending to those whom you trust and you don't have that problem with. In some countries, that thing has been tried. I think the impression I get from the SACCO kind of experiment and the microfinance type institute experiment in many countries in Africa is that common bond is very difficult to maintain, and it has to be a real focus of the institution and those institutions we're working with. So it doesn't mean because it's a SACCO it's going to work like that. You have to address this in a very specific environment, and you have to be and that risk reduction isn't a given. So that's a lot of effort and a specific kind of commitment, not only members but also on those managing the SACCO. So it can be made to work, and I think there are cases of microfinance banks, for example, in Nigeria, which I know quite well, where this does work and where this is making an impact on their ability. Doesn't mean to say that that's true of many microfinance banks, and there are many hundreds of them in Nigeria. So it's the exception rather than the rule.
Thank you. We have another question from Lucio. Rent-to-own schemes seems the more tangible ways via which the private sector can design housing finance products themselves. Who do you see the best macroeconomic context to enact this at the moment?
What framework was it for? What?
Indexation and rent-to-own schemes.
Schemes.
Yes.
The indexation schemes have been tried most in Latin America. That was because the high inflation rates in Latin American countries and the tendency to dollarize was so prevalent that to maintain some sort of local markets, there was a move towards trying indexation schemes. So if you look at that's probably it's countries in Latin America one needs to look at. That's to own. And I think that in the paper you'll find the references. There is references to certain countries there, which I don't on the moment recall which countries we're referring to there, where that's been more prevalently used. So that like the installment credit idea that you would over time you lease your property, and over time you repay that on the property value, and it becomes yours later on. So yeah, and on the spur, I don't know exactly which country to refer that question to. Refer to the paper.
Thank you. I invite actually all participants to go on the Affordable Housing Finance website. The link is on the last slide. You will see when we will circulate the open presentation at the end of the webinar. Full report that Michael published last week and for information. We have for one more question. If there is any question, would like one last question. Okay, I think we are done for today. I want to thank Michael Fuchs for your presentation. I want to thank Mundo Mabasa for his comment, very interesting side comment. The participants, please do not forget to fill out the survey. We share with you, I mentioned all the Michael presentation, Michael full report, and so the recording of this webinar. And thank you for your time, and I wish you all a pleasant day.